Good morning, everybody. Good to see all of you here again. Some people I've seen many times, some people I've not seen for a long time, some people I've not seen for 20 years. What I'm going to talk about today is IFRS 9, and for the pricing agency to talk about an accounting standard is a little bit out of our area, but I think it is very, very relevant to everybody who is involved in the bond market. There has been a lot of talk about IFRS 9 and a lot of concern about how it will be implemented, how it will affect people's profit and loss, people's balance sheet. So what we're going to do today is I'll take you through what basically IFRS 9 is all about and how that specifically relates to fixed income. So, International Financial Reporting Standard 9. It is the replacement of International Accounting Standard 39, which was the previous accounting standard governing financial instruments, and it was released in 2014, and it will be implemented globally on 1st January 2018. And actually from this point on already people can adopt it early into their financial statements. I'm not yet sure if anybody in Malaysia has adopted IFRS 9 yet. Yeah, because there's a lot of unknowns, so to say. So in terms of what it is about, if you can see there, three main areas: financial assets and liabilities, expected loss model, and hedge accounting. So on the first part, classification and measurement, that's pretty much similar to what was done before on what we call the mark-to-market process. And the hedge accounting, we're not going to talk about it here. What we're really interested here today is the second part, which is the expected credit loss model, which is something very, very new in financial reporting. So the way it is done is substantially different from the previous standard, IAS 39. In IFRS 9, what they want you to do is basically determine your business model. So for an entity that is a trading entity, your business model is to trade instruments. If you are an insurance entity, for example, you are holding that instrument for its cash flows. And then you could, for example, holding it as well as looking to sell it. So if we translate that to our own books, that looks like HTM amortization, which happens now, your trading book, and your AFS book. And how does the standard tell you to treat the instruments which have been classified in each of those books? And you can see already that some things will need to change. When they implement this, there's going to be book transfers necessary, changes in treatment. And if you look at it, the center one, fair value through profit and book loss, we call it FVTPL. That is already in place now. That's how you do your current mark to market. On a daily basis, you mark your position, you take a profit and loss from there. So that's fine, that's done, that's already in place. The other two in red, amortization on your investment book, and FVOCI, which is how you treat profit and loss generated or earned on the AFS book, both of which require impairment provisioning. So this is impairment provisioning is something which has existed before in IAS 39, but the way it is done in IFRS 9 is going to be different, and it's actually very, very different. I'll come to that. Now, The difference is in the previous accounting standards, and accounting has always been a historical affair on an accruals basis. IAS 39 looked at losses which happened during the year and then you provision it at the end of the year. IFRS 9 requires you to make a forecast of the next year, 12 months forward, after your balance sheet date. So this is something which has never happened before in accounting, and accountants are generally very, very conservative and boring people. I was one. And this is very adventurous from an accounting point of view. So, what is the expected credit loss model? It's supposed to avoid the problem of provisioning too little, too late. And this is what happened in the subprime crisis, in the Eurozone Greek crisis, whereby people only took into account the losses after it had happened. And that wiped out people's balance sheets, and it was very, very sudden shock. So the accountants decided that, why don't we do it in anticipation? Let's provide for the future now. And so the expected credit loss model was developed, and this took a very long time to develop. There was a lot of discussion about how it should be done, and even to this day, and I suspect in the future, there will be continued argument about how to use this ECL. Even now, among the audit industry, there are different interpretations of how it should be handled. Some just don't know. And we're not just here talking about fixed income, if I may say. It applies to every kind of asset and liability class. So whether you have a portfolio of loans, mortgage, credit cards, receivables of any kind, all of that will be subject to IFRS 9. But here we're just going to talk about fixed income for today. And it says deterioration in credit risk. We're not talking about interest rate risk, liquidity risk, any other kind of market risk. We're actually trying to quantify credit risk by itself. And when we talk about corporate bonds, first thing come to mind is, okay, rating possibly downgrade, that's a impairment, right? No, it's a lot more than that. It's not that simple. So it can have a huge impact on financial performance. Once this standard comes in, people may have to take a very big hit on their books if they have to provision. Volatility in P&L. Capital regulated entities such as banks, which have, like, for example, Basel requirements, they were going to have to take into account this. And the amount of data that you need to actually implement IFRS 9 is frightening. I mean, I look at it and I feel sorry for you guys in a way, but it's got to be done. Now, it's for big entities which have very established risk management infrastructure, then it's not so difficult. You have big data sets which you can rely on. You have probably good vendors like FactSet supplying all kinds of data to you. But the smaller and the medium entities, these are the guys who are going to be affected, because you probably might not have that infrastructure in place. You might not have that database, and suddenly you're going to have to get all of this stuff. So overall, we see it as a big challenge for everyone, not just for the people in the finance department and the financial reporting department, people in treasury, people in risk management, everybody is going to be affected. And that's why the title of my presentation is Accounting Meets Risk Management, because these are a lot of risk numbers involved. Go one level down. What is this expected credit loss model? Basically, we need to evaluate the performance of our portfolio, whether it's a portfolio of bonds, T-bills, commercial papers, bankers' acceptance, NCD, every kind of thing. the key question to ask is, has there been a significant increase in credit risk since initial recognition? So initial recognition means the day you put it on your balance sheet, the day you bought it, the day it goes into your accounts. And IFRS 9 gives some very general guidelines on how you should measure this increase. But I looked back into IAS 39, which gives very more clear explanation about what all these factors are. And if you can see there, they have listed down quite a number. Disappearance of active market, downgrade of credit rating, fair value below amortized cost. Because as you know, if you're doing fair valuation on mark-to-market, there's a completely different thing from amortization. It's a completely different accounting treatment. Local or national economic factors, and you start to have to think about the economic performance of the market in the next 1 year. And we never had to do this before in accounting. Concessions, financial difficulty of the issuer. And then they go on to say, it may not be possible to identify a single event, but you have to look at the combined effects of several events. So, like I said, if you just say it's a rating downgrade or rating negative outlook or whatever, that's not enough. You can't provision or based on that. Now, again, more detail. They give all this, there's like thousands of pages of stuff about how we should look at all this, and they've given so many different factors. This is under IAS 39, which is changed actually, but in principle I still believe it applies. And these are the things we need to look at when you say whether you need to provision, is there going to be a credit loss or not? If and only if objective evidence of impairment as a result of one or more events. Right? And then they give you all this list. Significant financial difficulty, breach of contract, for example, the bond issuer coming to you and trying to negotiate delays in payments. Ratings is just one aspect of it. And yeah, as you can see there, so many things. Changes in the cash flow, and so on. Disappearance of active market. If the bond suddenly disappears from trading, and it can be known that that happened because of some issue with that instrument, then it will have to be something that has to be studied, taken into account. There you go. And then they give you all that list. This is how accountants work. Right? They give you all this list of things, and then they say, well, actually it's not really about that. There you go. The disappearance of active is not evidence. They give you a list of all the evidence, and then they say it's not evidence. So now you understand why I left accounting and went bond market. There is no future. So it makes it very, very difficult for people to interpret this into a procedure, into a process. And the standard tells you what they want, but it doesn't tell you how to do it. That's what accounting standards are about. And you can see there, you read there, may be evidence when considered with other. You know, it's not like full stop, that is something, it's maybe. So a lot of vague, you get the drift. I just extracted a lot of these paragraphs, which give you some key ideas about how this thing works. It has to be measured at the original effective interest rate. Now what does that mean? That means at your original coupon rate. You have to discount the future cash flows at your coupon rate, not at the yield to maturity. Okay? Different. And it can result in a single amount or a range of possible amounts. So then it's up to the entity to apply whatever model that you come up with the data you have, and it says, in the worst case, we need to provision 10 million. In the best case, we need to provision 2 million. So it gives you a range of 10 to 2. it's up to the management or the policies whether you want to provision full, how aggressive you are in your provisioning. So there's a lot of leeway, which seems to be, and at this point in time, because implementation is still 1.5 years away, there's still a lot of questions which nobody can answer. I mean, we even speak to Malaysian Accounting Standards Board, MASB, and they're asking, well, why don't you tell people how to do it? We tell people how to do it. We can't tell people how to do it. So, you can see that. So let's look at it again. You have a whole list of, I've summarized it into 6 of the key things: liquidity, disappearance of active market, credit rating, decline of fair value below amortized cost, and the rest, 6. Now let's try and look at, correlate that to the data sets which exist, because it's all about data. And disappearance of active market, obviously you'll have to look back and consider each instrument in terms of its trading over the last year. Has that trading declined? Has it disappeared? Has it become suddenly very active? And some sort of scoring mechanism would help. Credit rating, of course, the actions by the rating agency, upgrade, downgrade, rating watch, outlook, negative, positive, all of that comes in. Probability of default, because that's how it's calculated. The expected loss is the probability of the default multiplied by the loss given default, LGD. So, probability of default numbers, and at this time, both our rating agencies do publish rating migration and default studies, but I believe, and in our discussions with the accounting people, audit firms, it's an issue of timeliness. Whether it's that in time for your book closing, is that data relevant or outdated? Of course, decline of fair value, price and yields. You talk about local or national economic conditions, that could be, in a very, very general terms, it could be index performance, how the market has performed for that segment, AAA, AA, that industry, that issuer. And the granting of a concession, we look at it as probably could be related to implied ratings, because the market will react faster. A lot of concessions are given on a bilateral basis with the bondholders, and the market will react straight to that way before the rating agency would. So you could then start to think about what kind of data which already exists in the market which could be applied for these factors, for these criteria. Now, what are the data sources? Of course, BPAM is the data source, but just tell you what we have that could help. The first one, liquidity score and trade data. A trigger would be, they say, okay, disappearance of active market, what does that mean? How has volume improved or deteriorated over a period of time? And we actually calculate these numbers. We have what we call a liquidity score, which could be used to give an assessment over that period of time whether that instance has happened or not, and it could be an input into the process. So, liquidity score. Credit rating obviously is an important thing to look at, that goes without saying. And of course from the rating agencies themselves, and even on our screens you can get all of that stuff. And again, paragraph 60 of IAS 39 already says, is not itself evidence, although it may be evidence. You know, like, this is like politicians talking, you know. So, credit ratings, migration and default studies. So it says on page 89, future cash flows are estimated on the basis of historical loss experience for assets of similar credit risk. So obviously the important thing here will be migration and default studies, the probability of default for each different rating class, for example. And what we do, we generate this every quarter, because that was one of the issues raised by the accounting standards people, that timeliness of the data could not match a lot of people's financial year ends, 31st March, June, September, December. Whereas traditionally the report comes out once a year. How do you use that for something 6 months, 9 months away? So we tried to fix that problem. We actually combined RAM and MARC into one. So we have a market-wide default study and probability of default for every instrument that is rated. So that data is available. Again, historical price, if we talk about decline of fair value below amortized cost, if your book value, you're carrying it at, say, 95, but the market price is trading at 60, and consistently trading at 60, then that could be something to look at. That market fair value is way, way below your book value. Is that caused by a credit perception? If it is caused by a credit perception, then should you provide for it? So this data, I think most of you already can see. If you are using our mark-to-market price, then definitely you can already do that comparative very, very easily. Issuer-specific analysis, and we do generate issuer yield curves for each name. We have a yield curve for it. That can be obtained from our transparency tool. And that you can see whether individual issuers are behaving worse off or better off relative to other peers. You can do that comparative. And basically I would say that's a reflection of concessions. That's how a market reacts to a specific issuer being different from other peers. On a big scale, they talk about national or market-wide factors, and they look at the technological, market, economic, or legal environment. How do you measure all this? Can't put a number on that. So the closest thing that seems to be a very good barometer of the market would be the index, which takes into account practically everything that happens in the market. And again, because the index is granular, our series of index is very, very granular. So you can go down to actually individual credit class, AA, single A, tender bucket, and so on. So this could be a very important indicator of how the market is performing. Is your bond performing better or worse than the market in that similar class? Implied ratings. Again, a very powerful data set. We're talking here about very, very specific factors that affect each issuer, and each individual bond carries its own implied rating, and that implied rating is very, very sensitive to anything that affects the bond. Some of that information may not be available to the public, but it would affect the bond anyway, because the bondholders know what happened and they probably want to sell off the bond. The yield would go up, the implied rating would change. It's not a market-wide factor, it is very, very specific. So if I relate this back to what IAS 39 said about the trigger, the lender granting the concession, the borrower concession, it's a very bilateral or a group of issuer and bondholders. So if there's a sustained divergence, if, for example, this bond is like consistently trading below its rating, its implied rating, for example, is single A, but its credit rating is triple A, that is a very, very important sign that market perception of risk is negative. And we did some mathematics about this. We're comparing the credit rating and the implied rating in terms of the thresholds, you can see. And we can do some calculations and we can actually come out with a theoretical value of how much loss or gain that bond actually realized from a credit perspective, because applied ratings talks about credit only. So now, so if you look at it, the data sets are there already. It's a matter of how you take it into the system, how do you put it together, and how do you justify that in your accounting policies, and at the end of the day justify it to the auditors. And if you have a solid data set that is recognized, then auditors won't give you such a hard time. It's like, okay. And rather than creating your own, which is like reinventing the wheel, and then you, after spending all that time and effort, the auditor will say, oh, this one cannot use. So, unfortunately, we have to live with it. Accounting standards is a way of life. It's a tragic, it's such a profession as accountants. And I can speak because I was one, so I know. In conclusion, if you look at the factors, again, if I just list it down, you can see there, and the kind of data sources that we have in place. And I believe that going forward in the next 1.5 years, it's quite likely that we will get feedback, and that's why we welcome input from you guys, all of you. If you have certain data sets you need to fulfill the requirements with your accounts people or your auditors, then you can come to us and we can see whether we can put that data set together. Because you want to implement this with minimum hassle. You don't want to go through a nightmare. And I understand that even people in the dealing room are being roped in to be involved in this, which traditionally nobody wants to know. So data sets, you need these data sets. You need to calculate to run the expected credit loss model. You need the trigger data, like I said just now, all those different factors. You need the probability of default. You need the LGD numbers. Now this one you yourself have to come up with LGD. BPAM can't do that, obviously. The cash flows of all your instruments, and of course the original effective interest rate, and then you just apply it to the formula and then you treat it accordingly. So on the outset it looks doable, but you've got to go in with a plan. So it's all about data in summary. And I think the fourth one, important, accepted by the audit industry. This makes life a lot easier for everyone. And again, digital, delivered in a digital format that is efficient, straight into the system, straight away run. A lot of that data may already exist in your risk management database. It's just a matter of formatting it and bringing it out. And there are other data sets that you can add in. Right, that's it from me. If you have any questions on IFRS 9, happy to take it. Or we can leave it later. Coffee. Yeah.